The following is a production of Professor Robert Barnwell. Each episode includes insights provided by the chairman, CEOs, and CFOs of the world's most successful corporations, as well as thought leaders from premier business schools and international consultancies. If you and your team would like more information on corporate leadership and strategic management, or would like to learn more about Professor Barnwell, his research, and how he may be able to assist your company, please visit Professor Barnwell's website at robertgbarnwell.com.
Hello and welcome to CFO Talk Radio. I'm your host, Robert Barnwell. This is the first episode of CFO Talk Radio, so before we speak with today's guest, I wanted to tell you a little bit more about the program. CFO Talk Radio is focused on providing practical and immediately implementable management tools to the world's senior-most financial leaders, including CFOs, chief accounting officers, treasurers, controllers, and other corporate finance professionals. The program will serve as a digest of the current and most enduring finance and management concepts from best-selling authors, management journals, and consultants, as well as directly from the senior financial leadership of many of the world's largest and most successful corporations. While CFO Talk Radio and our companion show CEO Talk Radio are produced primarily for business leaders of companies or large subsidiaries with total sales in excess of $100 million and total employees of 100 workers or more, the concepts and principles will prove useful to the leadership of companies of all sizes. Ideally, each episode will last 20 to 30 minutes, about the average commuting time to and from the office for our listeners. Free subscriptions to CEO and CFO Talk Radio are available on iTunes, Microsoft Zune, or through BlackBerry Apps Podcast. Today's guest, our first, is the editor-in-chief of CFO Magazine, Scott Liebs. Scott has been with CFO Magazine for a number of years and has witnessed a significant change in the business and operating environment of the CFO and senior finance team. Today, I've asked Scott to chat about his views on the evolving demands on the CFO and the evolving nature of the CFO role itself. Scott, welcome to CFO Talk Radio.
Well, thank you, Robert. I'm glad to be here today.
Good. We're happy to have you here. And I guess if I were to say that these have been a crazy couple of years, I'd be guilty of gross understatement. What would you say have been maybe the five largest changes you've seen recently, or perhaps trends that impact today's CFO?
Well, these last couple of years of the Great Recession have been a really odd mixed blessing for CFOs. On the one hand, their skill set is very much in demand. There's been additional limelight shown on them, and it's been a chance for them to really show their stuff and in many cases really grow. But at the same time, it's come with incredible stress, higher turnover in certain circumstances, and maybe they've learned some lessons that they would just as happily not have learned. I think that if I had to point to maybe the five biggest challenges they've had to face in the last couple of years, in no particular order, or maybe going in order actually, I would say forecasting is what we hear them talk about the most in terms of something that they just wish they could get their arms around. I don't think companies were ever terribly good at it, but I think that virtually every CFO will admit that in the last couple of years it's become almost impossible. In fact, we interviewed the CFO of a large logistics company about a year ago, and he flat out said that his company has completely given up on even attempting to do forecasting. Certainly lining up credit and capital, while it's easing somewhat, especially for larger companies, remains a major concern for smaller and mid-sized companies, and was something that everybody was struggling with at the peak of the recession. Related to forecasting, I think weak consumer demand is something that plagues CFOs and companies today, and I think that the prolonged trouble in the housing market and the expected prolonged bleak outlook for employment bodes ill in that respect. We survey CFOs every quarter in conjunction with Duke University, and we ask them what their top 5 internal and top 5 external concerns are. And when it comes to external focuses and external challenges, weak consumer demand has been their number one or number two pick for about 10 quarters running now, and I'm not sure that I see that changing. There's also the stress of layoffs and workforce restructurings, trying to figure out how much further they can take that, trying to avoid it when they can. I mean, CFOs, granted, it is a lever they pull when times get tough, but they are not oblivious to the impact. Partly that goes back to they know that they're contributing to the weak consumer demand that they themselves complain about in terms of hurting their own business prospects. But on the human level, nobody likes to announce any sort of layoff whatsoever. And then I think the fifth thing that I would point to, and this is something that we hear about again and again, is just the difficulties of dealing with a general climate of uncertainty, whether that is uncertainty about what regulations are going to usher forth from Washington and exactly what form they will take, uncertainties about consumer demand and the real estate market and the employment situation that sort of underlie that demand. Just across the board, I think that when people use this phrase and overuse this phrase, new normal, it is essentially a proxy for a world in which uncertainty seems to be, ruling the day. And I think people would love to see that abate somewhat, but I have absolutely no idea when or how that can be made to happen.
Now, you're right. I mean, there are just so many challenges out there to confront. And then, as if this weren't enough, I don't know if I read this in CFO magazine, but I came across a statistic where the average tenure of a CEO is now just over, I believe it's 36 months. And surprisingly, the average CFO tenure is now around a year and a half, 18 months. Now, I mean, what's going on here? Are CFOs kind of being thrown under the bus to take responsibility for perhaps some underperformance? I mean, what's really driving, this shorter and shorter tenure of CFOs, and what can CFOs do in this environment?
It's very tricky, I think. We do a lot of reporting on CFO tenure, and we have seen it, tick down as well, or we have reported on other organizations that study it. But it's a very mixed bag. In some cases, CFOs are leaving because they simply have better opportunities elsewhere. In some cases, perhaps motivated by the stress of the recession, they are simply retiring because they've got the financial means to do so. And there are some sort of situations, no doubt, where they are either being thrown under the bus on a sort of personal level because they're deemed as being culpable, or they were brought in with a CEO and it's sort of out with the old and in with the new. So it is a real mixed bag, and before I made any sweeping generalizations about whether CFOs as a class of employee are under attack here, I think we'd need to parse those numbers more carefully. I wouldn't be surprised, all of that said, to see tenure numbers actually start to tick up in the quarters ahead, because what we have been seeing is that CFOs are much more apt these days to stay the course and stick with the companies that they know well. They're more risk averse in terms of taking on new job opportunities, assuming that any are even offered to them, and we may talk about that a little bit later in the interview. But I would bet that for those that have lasted out this recession and have steered the companies through, we are going to see them, staying with what they know a while longer. And I think that on the macro level, that is going to send tenure figures moving up in a more positive direction.
Okay. Well, we've also seen the pressure of activist shareholders and board of directors, driving a lot of, the agenda at corporations. I mean, is there anything that the CFO should be doing or thinking about that they haven't traditionally done or thought about? Again, vis-a-vis, the activist shareholders and board of directors?
I think the big challenge in that regard for CFOs is going to be to move away from the cost-cutting mindset that is part and parcel of being a CFO very often. It's something that many CFOs are wired to do, and it's been a skill set that has been heightened in the last 2 to 3 years as companies look to cut costs wherever they can, and the CFO is extremely adept at poring across spreadsheets, tightening up efficiencies, looking for ways, figuring out how to do more with less, and all that sort of thing. By their own admission, and again, harking back to the quarterly studies that we do with Duke University, they will now, as a group, readily admit that they have gone about as far in that direction as they possibly can. They have literally tightened every screw. Now I think the challenge for them going forward is going to be to transition from cost cutting to a focus on growth strategies and putting to better use the hordes of cash that most publicly traded companies are sitting on. This is going to be a real gear change for a lot of CFOs, and some will rise to the occasion and really welcome it, but I think some others will struggle with it. But if they are wondering what kinds of questions they're going to be getting from their boards and from their most vocal shareholders, I think it's going to be, what is the story for growth that you've got to tell us, and what kind of numbers or metrics or assurances can you put behind it to make us confident that we do have a growth strategy and that, in fact, it is the right strategy.
See, it's interesting that you say that, because it fits nicely with the things that I've been hearing from research participants in my studies as well as clients, and that is that the CEOs that I speak with have said, look, I really need a CFO who I can look at as a business partner and advisor. Beyond just traditional accounting and finance responsibilities, somebody who really understands the key drivers of the business and growth. I mean, are you seeing that in terms of the demands on the CFO to take a more strategic partnership role?
Oh, absolutely. I think that CEOs are, by their nature, growth-oriented, and they are perennially optimistic. And I think that in today's troubled times, they are realizing that before they launch the company off on a grand new venture or a great new idea, they need some solid guidance from their CFO. And when we ask CFOs what it means to be a strategic CFO, the answer that we most commonly get is the role that they play in helping their companies create smart and very carefully considered growth strategies. Now, that's also a challenge for CFOs because, very often, and not completely without reason, they are painted as Dr. Knows, people who poke holes in business plans, people who are very risk averse, people who can think of a million reasons why an acquisition will fail or a new venture of some kind won't pan out as expected. And this is something that I think they need to overcome. But at the same time, I think CEOs are realizing, there's a value in that. And if we can talk this out together, if I can hear from the CFO, what we need to be wary of, and if the CFO can understand why I think that something is a good idea or something does have potential, then together we can go forward with a growth strategy, but we can have more confidence around it, that it is not just something that's pie in the sky or wishful thinking, but that we have really thought this through carefully, and when we pull the trigger on it, we can feel about as good about it as we possibly can.
Absolutely. I mean, when I think of the strategic decisions that a business has to make, what products, what market segments, I mean, really getting behind those numbers in terms of projecting market share, cash flow. I mean, these are part and parcel of what the CFO, in my view, really needs to be a part of. Helping set performance metrics. Where should we be as we unroll our strategy, execution, and implementation? What are those performance measures? What are the benchmarking? I'm hard pressed to think of a better individual or a better team than the CFO's team to tackle those types of projects.
I agree. CFOs and their finance teams have the skills that are needed to address those kinds of quantitative issues. And I think there's another opportunity for CFOs as well. A few months ago, we did a story that was extremely well received about how companies can expand into the Brazilian market. To be perfectly honest, we were a little bit wary about doing that story because we felt like every other business magazine has talked about the promise of Brazil, and they have done a story, somewhat in that regard. But what can we bring to the table there that other people haven't covered? But we dug into it and we realized that expanding into Brazil poses some issues that very often go overlooked by companies, such as the very complicated tax structure that exists there, the very difficult to negotiate legal environment that exists there. Those are the sorts of operational issues that companies very often miss out on because somewhere between the grand plan that the CEO envisions and the hardcore metrics that CFOs traditionally run are these other issues that fall somewhere between macro and micro. And I think the best CFOs are realizing, when we're exploring strategies like this, if we don't do it, nobody will. And so we as the finance department have to not just provide the sort of, benchmarks and metrics that we understand that we've always provided, but we need to poke our heads up a little bit here and look into some other areas and see what other risks there may be and what other concerns we can surface and put some numbers to so that we take our due diligence to a higher level.
Terrific. Well, before I let you go, I'd like to get your thoughts on a question a client recently posed to me. And the client is currently a privately held corporation. It was privatized from NASDAQ a few years ago. In any event, they created a new position for the CFO. They had, I believe, a controller, but they didn't have a formal CFO. And they just created this position, brought on a really strong individual, in my opinion. And they were having a debate on whether or not the CFO should be a part of their board. And specific to this company, I suggested against it. But I do know that your magazine and many other thought leaders are kind of reconsidering about having the CFO serve on the board of their own companies and see a lot of benefit to it. You want to tell us a little bit more about your findings?
Sure thing. Yeah, there's no doubt that the Sarbanes-Oxley emphasis on creating more independent boards, and along with that, the effort by activist shareholder groups to demand that boards become more independent, works against having CFOs on boards. They're very often viewed as yet another insider sitting on the board, and thus preventing the board from bringing the outside perspective and expertise that is its charter. That said, a recent study by three business school professors at Bentley University and Northeastern University, both right here in Boston where we are based, took a look at the roughly 8% of 7,000 publicly traded companies that do have CFOs on their boards. And they found that while small in number, these companies did outperform their peers in a number of interesting metrics, being they were 25% less likely to report a material weakness. They were 15% less likely to restate results, and they were also less likely to demonstrate certain signs of earnings management, such as lower discretionary accruals. That gets into some sort of arcane accounting issues. But in the biggest picture sense, you could say that they ran tighter financial ships, apparently as a result of having a CFO on the board. The interesting thing that the study mentioned but wasn't able to explore fully is why should it be that companies that have the CFO on the board do better in these regards than companies to whom the CFO reports? And I think a lot of that comes down to the soft issues around, just how do boards operate when they gather around a table and they talk. It could be that it is one thing for a CFO to come in and give a very polished pitch and give them all the information they need and then walk out again, and it's another thing for the CFO to be in the room full time talking through these issues, that having the CFO there does result in some greater efficiencies in this regard. All of that said, however, I think it's highly situational. One expert suggested that, well, maybe it makes sense to have the CFO on the board if the understanding is that the CFO is the heir to the CEO, and by participating on the board, he or she will get a better look at the company's strategic imperatives across the board, so to speak, and be in a better position to assume the CEO position. But balancing all that against the overwhelming push for boards to become more independent, I would say that in general, I don't think that you're going to see a big groundswell of support for having CFOs sit on boards. What you might see is an acknowledgement in certain quarters that on a case-by-case basis, it can make sense, but that before companies put yet another insider on the board, they're going to have to be pretty explicit internally and externally as to why they think that's a good idea.
Oh, absolutely agreed. Well, today we've been talking about Scott Liebs, editor-in-chief of CFO Magazine, which is available at CFO.com. Scott, I've really enjoyed our talk, and if you'd be willing, why don't we try to get together again on a fairly regular basis, maybe every quarter or every half year, and check in and see what you guys have been up to.
Robert, I would be very happy to do that.
Terrific. That was CFO Magazine's Scott Liebs. Please join us for our next episode when we speak with Gary Crittenden, former CFO of Sears Roebuck, Monsanto, and American Express, as well as Citigroup during the trying 2007 to 2009 credit crisis. In addition to his various CFO roles, Gary has also served on the boards of several equally well-known New York Stock Exchange-listed corporations. Gary has agreed to join us to discuss the insights and experience he's gained throughout his long career. Until then, this is Robert Barnwell and CFO Talk Radio wishing you all the best.
We hope that you have enjoyed this episode and found the material of value. To download a transcript of this episode, receive a free subscription to the show, or to learn more about this subject, we encourage you to visit Professor Barnwell's website at robertgbarnwell.com to explore the many executive briefings, presentations, case studies, and other resources available for immediate download. This has been a production of Robert G. Barnwell. All rights reserved.